Welcome to FinTech Guru. Here we are analyzing Indian stock market from its official sources. All the materials are strictly for study and research purpose only. For investments, you have to consult with your SEBI-approved persons or do on your own. Again, welcome to SIVA Presents FinTech Guru. Today we're diving deep, really deep, into VA Tech WABAG Ltd. You'll often just see them called WABAG.
Right.
They're a global player, purely focused on water technology. And this is quite a moment for them. It's their centenary year.
100 years since 1924. That's quite something in any industry, let alone one this critical.
Exactly. And it coincides with what our sources, their latest annual report, the con-call transcripts, are calling a historic high performance in FY 24-25.
So our mission, if you will, for you listening, is to unpack what's driving this. We want to look at their strategy. They call it RIDI.
RIDI, yeah.
And see how that connects to the numbers, like that 20.2% jump in consolidated profit after tax year on year. We want to understand why WABAG is looking like such a key piece in the global water security puzzle.
Before we even get to the financials, I think we need to grasp their unique position. They sit right at the crossroads of sustainability, infrastructure, and tech.
Very much so. And crucially, they're pure play. Just water, sourcing it, treating wastewater, desalination, the whole cycle.
Yeah, unlike some bigger conglomerates that dabble in water alongside other things.
And the really interesting bit, the aha moment from the reports, is how they frame it. They talk about manufacturing water.
Manufacturing water. What does that actually mean in practice?
Well, it's about using their tech to take unusable sources, think seawater, or, heavily polluted industrial runoff, even municipal sewage, and turning it into safe, usable water.
So less reliance on groundwater or rainfall, which are obviously under stress globally.
Precisely. They're positioning themselves as creating water security by essentially turning a liability wastewater sea brine into a vital asset. It's quite a paradigm shift, really.
Okay, let's dig into that. If they're manufacturing water with technology, what's the actual product? What are they selling?
They're selling complex, customized solutions, not off-the-shelf plants, but complete engineered systems for managing water. The annual report mentions they have over 125 proprietary technologies in-house.
125? That's a serious IP portfolio.
It is. And that lets them tailor solutions that are cost-effective across the whole project life, from the initial design and engineering all the way through to running the plant long-term, the O&M side.
And the core areas they tackle are the really tough water challenges, right? High-tech stuff.
Definitely. You've got four main categories. First, desalination, turning seawater into drinking water. Complex, energy-intensive. They're apparently top 3 globally in this.
Okay.
Second, advanced wastewater treatment and recycling, super important for cities. Third, zero liquid discharge, or ZLD. This is big for industry, think refineries, chemical plants.
ZLD, that means literally no wastewater leaves the site.
Exactly. Everything gets treated and reused internally. It's a major engineering challenge, but vital for meeting tough environmental rules. And fourth, they do waste to energy, getting biogas from the sludge that treatment processes produce.
That tech focus seems to be getting them noticed globally, the rankings you mentioned.
Yeah, Global Water Intelligence, GWI, they re-ranked WABAG as 3rd globally among the top 50 private water operators. That's significant.
3rd in the world.
And the sources claim top 3 in desalination, world leader in water reuse tech. You see it in projects like finishing the marine works for that huge 400 MLD per desalination plant, Southeast Asia's biggest.
Right, I saw that mentioned. And an award for a project in Ghaziabad.
The Ghaziabad PTRO reuse project, yeah. It shows they're not just winning contracts, they're delivering complex projects successfully on a global stage.
Which brings us neatly to their business model shift. This feels like a really crucial point for understanding their current success. They've moved from traditional, heavy EPC...
engineering, procurement, construction...
towards this asset-light model. Can you break down why that shift is so important?
It's fundamental. Classic EPC is capital heavy. You need lots of investment up front, there's significant execution risk, revenues can be lumpy, and margins, well, they vary. WABAG's strategy is to minimize that direct capital outlay. They're focusing on the higher value engineering and procurement EP parts, and crucially, on long-term operation and maintenance O&M contracts.
And how does that help their financials and risk?
It de-risks the business significantly and stabilizes their earnings. Those O&M contracts are gold because they provide predictable, almost annuity-style cash flows.
Right, money coming in reliably every year.
Exactly. And typically at much better margins than the construction phase. It lowers their capital intensity, frees up cash, allows them to invest in what they say is their core asset, their technology and people, not factories.
So we know how they make money now, these different contract types. EPC still exists, but also DBO.
Design, build, operate.
And this PPM model, especially India.
Yeah, let's quickly touch on those. EPC is the basic build. DBO means WABAG designs it, builds it, and then runs it, maybe for 10, 15 years. That gives great long-term revenue visibility.
And HAM, hybrid annuity model.
HAM is interesting, particularly popular in India. It's very de-risked for WABAG. The government pays a chunk of the cost during construction, then the rest over many years as fixed semi-annual payments, annuities. And crucially, these payments are often backed by a central government entity, not just the local municipality. That shifts the payment risk away from potentially cash-strapped local bodies. It's a huge safety net for cash flow.
And this focus on high-value, often complex, de-risked projects is reflected in the size of the recent contracts they've won.
Absolutely. The reports highlight some massive ones. There's that consortium order for the Al Hair plant in Saudi Arabia, USD 371 million.
Wow.
Domestically, the Indosol Solar Desalination DBO project, that's INR 10,000 million. And internationally, the Lusaka wastewater plant, DBO in Africa. These aren't small deals. They lock in revenue for years.
Okay, so given this asset-light approach, the question always comes up. If they don't own big factories, where does the money get spent? What are the main costs?
Yeah, the sources are really clear on this. Their biggest costs aren't steel and concrete, they're knowledge and people. They explicitly call their 125-plus technologies and their 2,000-odd specialized staff their main assets.
So spending is on R&D, retaining talent.
Exactly. They spent INR 4 crore on R&D in FY25. Might not sound huge in absolute terms, but it's vital for keeping that tech edge, especially in the high-margin areas like desalination and ZLD. They're investing in the know-how to manufacture water better.
Which leads us to that mandatory question. What's the actual product and where is it produced? Let's hit production facilities first.
Okay, the annual report deals with this head-on. Quote, "We do not have any factories or production facilities, hence we do not have any workers on our rolls." It confirms the asset-light model.
So no WABAG factories churning out pipes or tanks?
Nope. They provide the engineering, the IP, the process design, and then typically partner with local contractors for the physical build. Production is, you could say, decentralized and intellectual.
So if they're not using traditional raw materials like chemicals or steel as their core input, what is the raw material?
It's literally unusable water. Seawater, municipal sewage, toxic industrial effluent. Their product is the transformation process, protected by their IP, that turns these liabilities into manufactured water.
Back to that concept.
Yeah, the sources really hammer this home. They're solving the water problem by making valuable resources out of waste, basically, ensuring water security without just draining rivers or aquifers.
Now, this high-tech, asset-light approach kind of demands a global reach, doesn't it?
Yeah.
How big are their international operations?
Huge and vital for diversification. They're in over 25 countries, 4 continents, and nearly half their revenue comes from outside India.
Half, okay.
Their approach is summed up as global expertise, local delivery, and they use this one WABAG idea.
One WABAG. What does that mean on the ground?
It means they pool talent across borders for big projects. Like the AD&OC projects, they brought in specialist teams from India and Austria to work together.
Sorry.
Their focus is on regions with serious water stress, but also, crucially, stable funding, often development bank funding. So the Middle East is keys, Saudi, UAE, Bahrain, Africa's another big one.
Any recent examples of wins there?
Yeah, they secured a 7-year O&M deal for BAPCO refining in Bahrain. That's a great annuity stream. And that big Lusaka wastewater DBO order in Zambia. It shows they can win and run complex projects in these key growth markets.
Okay, let's switch gears to the numbers. FY 24-25 looks like a banner year, driven by this RIDI strategy. Talk us through the profitability.
Yeah, the focus was clearly on profitable growth.
Yeah.
Management noted that profits grew faster than revenue. That points to margin expansion, likely thanks to that asset-light O&M focus.
Makes sense.
The consolidated numbers look good. EBITDA up 14.2% year-on-year, and that PAT figure we mentioned, profit after tax, up a strong 20.2%, hitting INR 2,953 million.
In standalone income.
Also solid growth, around 14.55% year-on-year.
The cash position also looks remarkably strong. Why is that so important strategically for them?
It's absolutely critical. They're reporting almost INR 1,000 crores gross cash, over 700 crores net cash, and over 350 crores free cash.
That's a lot of cash.
It is, and it's not just sitting idle. It's a strategic war chest. They need that liquidity to fund their share of the equity in those big ham and boot projects.
So it lets them bid for and win those high-value, de-risked contracts without having to constantly raise new equity.
Exactly. It fuels their ability to chase the most profitable deals.
Now, the crystal ball for future performance is often the order book, and the figure they reported is historic.
Historic high, yes. They closed FY25 with an order book around INR 136,667 million. Management rightly calls this robust future revenue and growth visibility.
And it's not just the size, but the quality of that book.
That's the key point. It's heavily weighted towards those higher margin EP and O&M contracts. And as we'll discuss more under risks, about 95% of it is backed by sovereign or multilateral guarantees, very low credit risk.
Can you remind us of the big wins making up that number?
Sure. It reflects their strategy. You've got the huge Al Hair project in Saudi Arabia. That's INR 17,212 millimeters, showing Middle East strength. The Indusal desalination DBO in India, INR 10,000 milliamps, highlighting DBO capability.
Right.
The Lusaka WWTP DBO in Zambia, INR 7,753 milliamps, proving African execution. Plus, repeat orders from big industrial names like Reliance in India, which shores up their domestic industrial base.
Okay, let's look at the ratios. These should really reflect that asset-light structure, particularly debt.
They absolutely do. Debt to equity is remarkably low at 0.13 for FY25, barely moved from 0.11 the year before. For any kind of infrastructure player, that's incredibly low leverage.
Confirms they're not borrowing heavily to grow.
Exactly. And their ability to service that small amount of debt is very strong. The debt service coverage ratio, DSCR, improved to 7.18 from 6.87. Anything over 1 is comfortable, over 7 is extremely comfortable.
And shareholder returns, ROE.
Return on equity held strong at 16.5% in FY25, slightly down from 17.1%, but still a very healthy return, especially for a capital-light business. Liquidity stable too, current ratio steady around 1.65.
So the ratios paint a picture of disciplined, low debt, profitable growth.
That's a fair summary.
And this turnaround hasn't gone unnoticed externally.
No, the credit markets definitely took note. India Ratings and Research, that's part of Fitch Group, upgraded their long-term rating to IND AA stable during the year.
AA stable. That's a solid investment grade.
It reflects the improved operations, the strong order book quality, and those risk mitigation strategies we talked about. And for shareholders, it translated into a recommended final dividend of INR 4 per share, a 200% payout on face value.
Okay, we've established the present strength. Let's look forward. The RIDI strategy is the framework. What are the main goals driving future growth?
RIDI's about sustained, smart expansion. Geographically, the focus is boosting market share in high-potential emerging markets. Middle East, Africa, Southeast Asia, CIS countries.
Places with water stress and infrastructure budgets.
Precisely. Often backed by development funding, which helps de-risk things.
And domestically in India, they're tying their strategy closely to big government programs.
Very closely. It's smart alignment. They're targeting the Namami Gange program, cleaning the Ganges. That means large government-backed sewage treatment projects.
Okay.
Then there's AMRA 2.0, focused on urban water supply and recycling, and the Jal Jeevan mission for rural water. Tapping into these massive multi-year national initiatives gives them a very secure domestic pipeline.
Now, this is where I think it gets really exciting for people interested in future tech trends. Their expansion into new industrial areas.
Yeah, this is beyond the traditional power and refining sectors, although those are still important. They're pushing into next-gen industrial water needs.
Like what specifically?
The sources mention biogas to compress biogas, CBG systems, water management for PV solar manufacturing, and then two really high-tech areas, semiconductor water systems and green hydrogen projects.
Let's pause on semiconductors and green hydrogen. Why is water for chip making so special? And why is WABAG suited for it?
Semiconductor manufacturing needs unbelievably pure water, ultra-pure water, UPW. We're talking purity levels far beyond even pharma grade. The tiniest impurity can wreck millions of dollars worth of chips.
Right.
WABAG's tech expertise allows them to design the complex systems needed for UPW. And just as importantly, to treat and recycle the very specialized wastewater these fabs produce. It's a high-value niche.
And green hydrogen.
Green hydrogen production needs vast amounts of very pure water for electrolysis. WABAG's skills in desalination and producing high-purity water are directly applicable. These are potentially huge, high-margin growth areas for them.
And underpinning all this potential growth is the steady buildup of that O&M portfolio.
Absolutely non-negotiable for long-term stability. More O&M means more predictable, annuity-like revenue. It smooths out the lumps from big construction projects and gives the market that earnings visibility it likes.
Now, this asset-light model is all about people and IP. What are they doing to nurture innovation and talent for the next 100 years?
They're investing strategically. They launched something called the Below E Seed Initiative in 2024.
Blue Seed.
Yeah, it's a program to foster innovation by investing in and supporting water tech startups. They're collaborating with places like the IIT Madras Incubation Cell. It's about being part of and maybe shaping the future water tech ecosystem.
Investing in the future ecosystem. And what about internal talent?
Also getting serious investment. They have leadership programs like LEX, Leadership Excellence Program, and YEPI, Young Entrepreneur Program, sponsoring high potentials for executive MBAs. And they brought on 150 graduate engineer trainees just in FY25.
150 GTs. That's a significant intake.
For a company whose main asset is brainpower, investing in that pipeline is essential to execute those complex global projects.
Okay, pulling this future view together, what kind of bidding targets did management give? How aggressive are they feeling?
Confidence seems high. They're aiming to bid for INR 15,000 to 20,000 crores worth of projects every year.
Wow, that's a huge pipeline they're targeting.
It is, but they're being selective, focusing on the high-margin de-risked stuff. And they're aiming for a pretty punchy win rate, 30% to 35%. That signals strong confidence in continued growth.
All right, let's shift to the caution areas. No deep dive is complete without looking at risks. For a project business like this, execution risk has to be top of mind.
It always is. The annual report flags timely execution as a key challenge. Get it wrong, and it hits your finances, your client relationships, everything. And the projects are complex. Think about the marine works for that Peru desalination plant.
Yeah, not straightforward.
Or just managing projects in potentially unstable political environments. Like they mentioned, navigating issues in Bangladesh requires real operational skill.
And with that global footprint comes financial risk. Currency fluctuations.
Definitely. Operating in 25-plus countries but reporting in rupees means constant exposure to FX swings, especially USD and EUR, as the auditors note, plus interest rate volatility. The group treasury uses hedging, but it's a constant management task.
Okay, but maybe the most interesting risk area and how they manage it is credit risk. Getting paid by municipal clients can be notoriously difficult in infrastructure.
This is where WABAG seems to have built a significant moat. Management was very clear on this in the con calls.
How do they avoid that trap?
They are highly selective. They explicitly state they do not rely solely on payment guarantees from municipal corporations.
Right.
Instead, an incredible 95% of their order book is secured either by multilateral institutions, think World Bank, KfW,
the German Development Bank.
Exactly. Or by sovereign guarantees.
Yeah.
In India, that means the central government backing, like for the Namami Gange projects via the Ministry of Jal Shakti.
So if a local body hits financial trouble, the payment is ultimately backed by a national government or a major international institution.
Precisely. It dramatically lowers the credit risk profile compared to many peers. It's a cornerstone of their de-risking strategy.
That's a powerful mitigator. However, the financials did mention a concentration risk in receivables.
Yes, that's the counterpoint, the detail we need to flag. While the backing is strong, the numbers show 91% of their trade receivables are concentrated among just 22 customers.
22 customers account for 91% of the money owed.
Yeah, each owing over INR 300 million. So even with guarantees, if there were administrative delays or issues with just one or two of those key counterparties, it could create temporary cash flow hiccups. Needs very close monitoring.
And lastly, geopolitical or funding risk. Especially in the Middle East, could volatile oil prices impact project funding?
That's a common market concern. Management's argument is that funding for critical social infrastructure like water security and sanitation, especially from development banks and multilaterals, is actually increasing year on year.
So less tied to oil price cycles than, say, luxury developments.
That's the idea. Plus, they have a formal risk management framework overseen by a board committee looking at all these geopolitical and financial risks constantly.
Okay, let's try and wrap this up. We've covered a lot of ground. WABAG seems to be this highly specialized, tech-driven, global water company.
Pure play, asset light.
That successfully shifted its model. And in its centenary year, it's showing strong financials and a massive high-quality order book, all guided by that RIDI strategy.
I think that's right. The key takeaway for me is that combination, the strategic pivot to high-margin EP and O&M, plus that really impressive credit risk management, the 95% sovereign or multilateral backing, that gives them a relatively clear, de-risked path for future earnings compared to many in the infra space.
So here's a final thought to leave you with, circling back to that idea of manufactured water. WABAG isn't just building plants. Their core value proposition is solving a fundamental global crisis: water scarcity. When a company's technology can reliably turn a societal problem, like wastewater or unusable seawater, into arguably the most critical economic asset we have, how should we value that? Does it decouple them from typical infrastructure cycles and align them more with, I don't know, essential planetary resilience? Something to think about?
A very interesting question for the long term, definitely.
Thank you for joining us for this deep dive into VA Tech WABAG. We really hope this analysis gives you some valuable context for your own research. Thank you to all our FinTech Guru YouTube channel viewers. And with a final request for subscription and to enable the notification button so that we can produce more videos like this. And a final reminder, all materials discussed today are strictly for study and research purposes only. For any investment decisions, you absolutely have to consult with your SEBI-approved persons or do thorough research on your own.